What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is March 23rd of 2020. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to explain why I believe right here, right now, we are living in one of the most extraordinary times when it comes to the history of major decisions for monetary or financial or fiscal policy that we've ever seen in the history of not only the United States, but the global economy. We are going through extraordinary times in response to a lot of the fear that's been going on around COVID-19 and a lot of the underlying worries in the economy and the underlying plumbing of the banking system. So I want to go ahead. We're not only going to be talking about cryptocurrency markets in this, but really just talk about the full scope of what's really going on here within a good summarized video here. All right. Now I want to let you all know real quick that this video is sponsored by eToro. Now, for those of you who may not know, eToro is a social trading platform that allows you to interact with other traders across the board, and you're able to not only talk to one another, but also you can copy a variety of well-known traders in the cryptocurrency space. So you basically find a profile you like, you check out their stats real time, see how they're performing, and you can simply click the blue copy trader button to trade alongside them. So if you're interested, check out the link down below in the description. All right. Now, I want to go ahead here and first off talk about cryptocurrency markets, because crypto is actually holding up quite nicely. Not only are most plays either holding in neutral territory, meaning they haven't gone up or down really over the last 24 hours, but along with that as well, we've really seen over the last couple of minutes, and I don't think CoinMarketCap has reflected that yet, we've been seeing a really nice bump up here in cryptocurrency markets. Bitcoin holding up quite nicely here ever since it had its pullback down here to around the upper $3,000 to low $4,000 range. And now we're pressing up higher in this case, looking like we might come back to revisit up here close to $7,000. And what's really interesting to see here is that Bitcoin, to many people, has been seen as this crazy risk-on asset, right? And to be fair, Bitcoin is one of the more volatile assets out there. But this week, it really has been looking like one of the more stable assets for the most part, because we've been seeing equity markets moving down as much as 5, 7, or 10% on some days. Because of this, Bitcoin, as it's been starting to actually perform more upwards price action as markets have been turning downward, is starting to show people that there's not so much a direct correlation with the pullback in equities as well as the sell-off here in crypto, right? These weren't exactly correlated to a degree. One of the components that led to the sell-off in crypto was the sheer demand in this case for the sheer demand for cash, right? Sorry, guys, I was slurring my word there for a second. But basically the sheer demand for cash, which is true across all markets. It's not really so much a direct correlation, but it was a direct causation as to why these markets came down, right? So again, important thing to note there, but there were a lot of other factors that really drove down Bitcoin's price, and I think now we're starting to see a recovery after those kind of non-correlated factors, in this case, that were dragging down global markets. And it showcases to us that Bitcoin itself still has a chance to be a hedging asset, an asset that could bet against the traditional system, that can hedge against inflation, which is something we really need to keep in mind right now, because it's going to be the key term we need to focus on over this coming year. So right now, equity markets right now are holding up quite nicely, up about 2% across the board, as finally it's looking like there might be some policy decisions being made. There's no confirmation just yet in regards to response for COVID-19 on fiscal policy, in this case, on what might be passed in the Congress. But we need to really talk about what's really going on behind the scenes that's really going to play a role in boosting the economy. And that's really what the Federal Reserve is doing. So the first thing here that's important to note when we're talking about this key term of inflation is that the Federal Reserve has committed not only to massive, expansive programs on increasing the total assets on its balance sheet, and that's including not only U.S. Treasuries, which are government bonds for the United States, but also mortgage-backed securities. Again, those toxic assets that they slowly but surely started to alleviate off the balance sheet yet again, but are now stacking back at a record pace. Now, it wouldn't only be concerning if they started to do these massive programs, but the Fed has made it clear that it's using a term known as unlimited QE, or unlimited liquidity. You've probably heard about this throughout the headlines. Now, some people might be cautious as to what that means, right? What does it mean when the Fed is going to be taking on unlimited QE, right? Or, basically, it's basically going to keep open to the idea of constant expansion of its balance sheet. These big fancy terms might kind of startle some people or might not make much sense. Long story short, it means the Fed is going to do whatever it has to do to keep markets afloat. It is going to do whatever it has to do to not only keep the credit system going in banking, but along with that as well, it's going to do anything it can to sustain equities at their current valuations. Basically, unlimited QE, simply put, means that it's going to inject as much cash as possible and exchange that cash for as much treasuries, mortgage-backed securities, and probably soon thereafter, equities. So the Fed's going to start purchasing up equities here probably in the future. It's going to buy up as much assets as possible and print as much money to pay for those assets. Now, where's the Fed getting the money? It's making it out of thin air. It's injecting mass amounts of liquidity or quantitative easing, right? So this is, again, trying to break down that kind of technical jargon. So they're basically saying, hey, any commercial bank, any hedge fund, you guys want to give us treasuries? You want to go ahead and give us mortgage-backed securities, those toxic assets that really, at the end of the day, probably aren't going to get, fulfilled at the end of the day, all those toxic loans underneath the books. And maybe, pass in some stocks, pass in some ETFs as well. We'll buy those from you. Here's some cash. Go have at it. Go make all the same mistakes you made before, right? That's what the Fed's basically doing, just to sustain credit markets, because they know if they don't, the whole system goes kaboom. It collapses, right? To put it simple, right? And then along with that as well, the Fed has not only taking measures of quantitative easing in the sense of its balance sheet, it's gone back to using the other major tool that it has, which is cutting interest rates. And it's cut it down basically to 0 to 0.25%, basically 25 basis points, if anything. So we're basically right back down to where we were from all the way back here in 2008 to 2015. So again, right on the cusp of pushing for what might be even more concerning than 0% interest rates, basically free money, is when you get paid to borrow money. And that is negative interest rates. We've talked about this. This is a reality in a lot of European countries, in Japan, and it's soon going to be a reality in the United States, because the Fed has decided it is going to do everything it can to sustain the system during this time of crisis. And honestly, in the sense of the system that we exist in this case, right? This system of artificial bubbles and central bank monetary policy, I'll be honest, who can really blame them, right? If you have these tools, they're going to probably use it during a time where we're at a chance of possibly 25 to 30% unemployment, where we have people being forced to stay home, where a huge percentage of the labor force is just not working right now, and consumers are forced to stay inside. I can understand why the Fed would probably respond to this, but I can tell you all, it's probably not going to sustain itself in the long term. So again, going back here, this is what the Fed is committed to so far. $75 billion of Treasury purchases each day, alongside $50 billion of mortgage-backed security purchases each day as well. You guys can do the math on this here, right? $125 billion of stimulus daily at a minimum. Now, if you don't believe this, this is public on the Federal Reserve's website. And one thing I always want to emphasize, guys, people try to understand, the thought process of the banking sector. They try to understand what the banks are doing right now. The good news is, whether they're legally mandated to or not, they put it all out there on the web, right? It doesn't matter if we're talking about the Bank of International Settlements, which is like the central bank of central banks, or if we're talking about specifically the Federal Reserve, or the Bank of England, or the European Central Bank, the ECB. Doesn't matter. All this stuff is public here, and you can see what they're scheduled to do today alone. Well, in about 30 minutes, they're going to be doing Treasury coupons from 7 to 20 year sector, in this case, basically maturity dates from 7 to 20 years, for around $8 billion. So they're just going to go ahead and inject $8 billion, just like that. At 10:20 to 10:40, maybe when some of you are starting to kind of get in your groove in your work, they're going to go through and do $12 billion of purchases. And when you're going through maybe your lunch break sometime here between 12 to 12:20, they're just going to inject another $12 billion in cash. No big deal. And this is all part of today's policy, right? Just to show you the kind of sheer shift in monetary policy that the Fed has taken on here. All right, you can take a look at the period here that showcases when these operations that are listed here are being conducted. You can see here, for example, that they had planned to buy about $20 billion in treasuries in this case, right? Excuse me, I know, so $60 billion in treasuries and $20 billion in mortgage-backed securities or reinvestment purchases. In this case, it's mortgage-backed securities. Back here between January 15th to February 13th, basically a month, to buy $80 billion of assets. And now it's doing about the same, just $5 billion short, on a day-to-day basis, right? You can see it here, and now they're starting to bundle it together here because they're basically doing the same thing for an entire week here, right? Or at least a working week, right? And in this case, they're just going to bundle it all together on one period here. But really, they're doing this every single day. So again, the ramifications of this are huge, guys. Not to mention, one thing that a lot of people haven't noticed as we've been hearing a lot about this Fed quantitative easing, QE4, They're finally having to call it QE4, and now they're calling it unlimited QE. We have now reached a new high on the Fed balance sheet. We have gone past the previous highs from back here in 2015, where we peaked at around 4.5 trillion. Well, that was very short-lived. the quantitative tightening that was talked about, right? And again, this is not shocking, guys, because the Fed cannot reduce its overall balance sheet for long, unless there are other means to relieve the economy. And quite frankly, a lot of those means were exhausted. The tax cuts that we had, the deregulation was, again, beneficial in the short term for the economy, but it all went into stock buybacks. It all went into artificial asset growth, and it didn't really go much into the real world economy. And because of that, the Fed now had to step in and inject tons of cash into the system, especially during a time like this when we have a global pandemic. And to make matters worse, right, we're seeing in the futures markets that it's looking quite confident here, and maybe we've got some resolution here really just in the last hour, hour and a half. But right now, we're still cautious as to whether or not the Congress and the Senate and inevitably the President will be able to pass a bill here that's going to satisfy the needs of everyday consumers and then also businesses out there that are hurting right now. So it's a matter of nailing monetary policy and fiscal policy. But the Fed has exhausted pretty much all of its tools here, right? We'll have to see what happens on the fiscal policy side. The important thing to take a look at that still, I don't see pretty much any news headlines talking about. I've seen a few, but not much at all talking about, is Treasury yields. We are on the neckline of reaching negative rates. Some people were reading, it depends on data sources that you're looking at. Some people had registered actually that some of the 3-month yields and the 6-month yields, a lot of these shorter term treasuries, that we actually did see negative rates and negative yields on treasury notes. Something that, again, we thought was maybe a possibility. Bear in mind, I take more of a bearish perspective here after the 10-year of a long-term equity bull market, right? When we started getting late 2018, early 2019, that's when we took our bearish position. So far, it's paid off. At the end of the day, though, the thing that concerns me most and shocks me the most, even as someone who's a bear, is just how quick we went towards practically 0% yields on treasuries. Now, it doesn't shock me too much because I know that the Federal Reserve, for example, sorry, I'll get the right chart here, there we go. The Federal Reserve has cut down interest rates to 0%, right, between 0.25%. And the Fed is purchasing treasuries like wildfire. So this is going to go down here. The yield's going to drop like a rock when you have a guaranteed buyer who says, hey, I will literally buy as many treasuries as you want to sell me. I'll buy them at any price. Doesn't matter, right? In this case, the yield's going to drop like a rock because the demand is so stark for treasuries. And when demand goes up, demand builds up in this case for an asset, price tends to go up and also the yield tends to drop. That's just how bond markets tend to work. But we're now on the cusp here of entering into negative yields on treasuries, something we have not seen throughout U.S. history. When we start to see that, it's going to be a question of how long it can sustain itself, because it can probably for a little while. But when the yield becomes so negative that it starts to outweigh any beneficiary factors of holding on to the spot treasuries in this case, right? When the negative yield starts to outweigh any gains you make on the treasuries in the sense of its actual spot price, that's when you've got a huge issue. And that's when you're going to have a huge correction, a huge reality check in the sense of the entire credit market. And again, you don't believe these yields, guys, this is printed on the Treasury's website, just like the Fed. It's all transparent. Yields are rock bottom here in the sense of short-term yields. And the other yields as well are dropping quite steadily. Only the 30-year is holding quite nicely here. I mean, 1.5% though for 30 years. I mean, that's pitiful. I mean, we've seen yields much higher in the past. But you can just see here, the shorter the time period, it tends to be that the yields are getting smaller and smaller and pushing closer and closer, edging closely to negative yields. And I think when we make that switch to negative, what's going to stop the Fed from dropping it another 25 basis points? Dropping the Fed funds rate down another quarter or half a percentage point, and therefore pushing Treasury yields even lower. I don't think much is going to stop them because, as Mr. Koshkari here from the Fed says,
you don't need to. your ATM is safe, your banks are safe, there's enough cash in the financial system, and there is an infinite amount of cash at the Federal Reserve. We will do whatever we need to do to make sure that there's enough cash in the banking system. You don't need to.
You don't need to worry, folks, because the Fed can print as much money as it wants. And if you think that the crazy repurchase programs that it's going through right now is going to be enough, I'll just wait. Give it a few weeks, because that talk we had for months, actually I would say probably up to a year on this channel, of the Fed buying into equities, that's going to become a reality very soon. They're going to start with ETFs. They're going to start with assets that sound much more kind of professional, like treasuries. They'll probably buy broad index ETFs to supplement supply, buy-side supply for the overall market. Make it seem professional, like they're trying to get diversification. But if you think bailouts are going to be where the corporate welfare starts, look no further than where the Fed can take it, because the Fed is the real player here. Yes, we can bail out a few players. Yes, we can provide tax relief. Yes, we can provide maybe paychecks or actual direct loans to these businesses, but the Fed is going to be the ultimate weapon. They have unlimited quantitative easing. They can print as much money as they want, and they don't care how much they're going to depreciate the dollar, so long as it keeps the system going. They have every incentive to keep the system going. And it's going to be an interesting experiment to see what this does for everyday prices of goods and services, what it does for the purchasing power of your savings, and where that money is going to end up going. Because if it ends up going into purchasing stocks, to purchasing treasuries, to purchasing mortgage-backed securities, quite frankly, I don't think you guys have that in your portfolios. At least the vast majority of Americans don't. The bottom half of America owns less than 0.5% of all assets. That's including treasuries, all other forms of government bonds, properties, stocks, you name it. This is corporate welfare at its finest. This is not a free market economy. And it's certainly not aimed at helping the average everyday Joe when they're devaluating the purchasing power of your dollars. Anyways, I've rambled on enough, guys. I hope you all have enjoyed this video. If you liked it, drop a like. I appreciate it. I love getting to talk about this. I mean, we're in a very, very extraordinary time here. Whether for good or bad, we are going through one of the biggest experiments of monetary and fiscal policy that we've ever seen in history. Now, there is one thing I want to share with you guys real quick. As you all know, I'm going to be speaking, or some of you might know, I've been having a link in the description for a while that I'm going to be speaking at Istanbul Blockchain Week, which is sadly going to be pushed back for a while, like most conferences right now, to be fair. It's a good move. However, though, as with Akon, as you guys might know, he's a well-known celebrity, I'm going to be attending Blockdown in this case, which is an online conference that's being hosted by EAK Digital, which is helping to run Istanbul Blockchain Week. And Akon, as well as many of the other speakers who are going to be attending Istanbul Blockchain Week, are going to be attending as well. So if you guys want to learn a little bit more, again, check out the links down below here. Go to Blockdown or check out the original IstanbulBlockchainWeek.com website, where you guys can find more information on when the details come out about this event. But I'm very excited to attend that as well as Istanbul Blockchain Week. But all in all, guys, this is an extraordinary time. I'm glad you all are here. And if you're new to the channel, definitely consider hitting the subscribe button, hitting the bell icon. Don't miss another video. There's going to be a lot of interesting things to talk about over these next few weeks. If you've felt crypto markets or any other market you've been watching has been kind of boring, folks, you have got an interesting storm coming here. A very, very interesting storm of all kinds of different things going on in the world. And we'll be here to cover it every step of the way. All right? Anyways, have a great day, everyone, and I'll see you all in the next video. Stay tuned.